All right. So in the Slack, I was mentioning if you have any companies that you want me to look through, just put them in the chat. And we've already got about 9. Shout out to Jim, Jeff, and Bear. So let's try to do this. I have a couple more of my own. So we'll have probably about 11 or so companies to go through, and let's just get right to it. So the first one is Rubric, and this. I didn't realize what day it IPO'd. I'm just gonna, let's see here. Oh, it actually IPO'd a while ago. I was just super late on that one. Okay, so with this, it's a recent IPO. Um, Koifin has the numbers already. So what I would first look at right here is growth seems to be accelerating into this 38%. This huge loss right here is just because IPO expenses, they usually do. When the stock finally comes public, there's the big options. Everybody wants to get their money. So stock-based comp absolutely balloons. You can see 630 million, but it'll even out over time. I think this is a Koifin error. Gross margins probably didn't drop off like that. Free cash flow is a bit lumpy, and of course the balance sheet is pretty solid because they IPO'd. Okay, so first thing I would try to understand is why is it accelerating here? So they might have the IPO prospectus. Oh, they actually have a 10Q. They've actually reported earnings. Thank you, Jim. I have been super behind on this one. So it's a cybersecurity company. But my understanding is they have a legacy business and then sort of a cloud business that is growing much faster. So yeah, you can see the cloud growing 100%, big decel from 200%, but that's really impressive still. And then overall subscription ARR is 46%. So the big chunk of the business is probably growing like just a little bit. Of course, it's pretty hard to find in here. They want to make sure that you see all the good stuff. So, yeah, let's see. They're making it a little bit hard to subscription revenue increased 59%, dollar-based net retention 120. So yeah, they basically have a legacy business and then a cloud business that is growing much faster. So I would have to break out exactly what that looks like. But yeah, at first glance, I'd be fairly interested. Um, I guess we can do that. I don't know if I've added this to the database yet. Yeah, I'm behind. I haven't added Q1, so I'll have to go back and do that. Perfect. But I would definitely put this on my interested list. I guess, what the heck? Why don't we just go through and do how I would do it? So I'd pull up the investor relations page, take a look at the actual quarter. So I have the fiscal years off here, but I think you can see this. You can see my screen just split. I would do like this. I guess this is on Koifin already, so there's no point of me really doing this. Um, well, we can see the guide there. I put guides in bold always, and then this is full year revenue, bold it. Weighted average shares, 179 million, 154. Yeah, so some of the timing of the shares after IPO is a bit weird. Okay, here we go. So revenue, 187.3. Gross profit, 91.3. I mean, gross margins actually nah, they might come down just because the SaaS business is probably, yeah, wow. They really came down. I I feel like there was some stock-based comp in the cost of revenue. That's my best guess, because actually customer support will go into there. So if customer support finally got their stock options, that's probably why we're seeing gross margins drop off a bit. So this is tricky because the gap gives you a huge loss, the generally accepted accounting principles, but in reality, if you take out that one time, it's probably not quite as bad. Okay, well, we can add this. This is good. So this company might take a bit longer. This video, I don't know if I could get through, because actually good companies, it's kind of hard to get through quickly. If it's a pretty poor company, it's very easy to just churn through these. Okay, we can pull up Koifin again. And so I would go and find the exact ARR and the cloud revenue, all that good stuff. Well, let's see if I can find the fully diluted share count. So I'm just pulling up the 10Q and then searching for diluted. And okay, so they have a bunch of RSUs, restricted stock units. So if we take out 630 million of stock-based comp, that's how we get the non-GAAP EBIT. Still losing about 100 million. So let's do negative 724. And then we'll add back the stock-based comp, and then we can get a more normalized picture. I mean, still losing a ton of money, so I wouldn't be that interested just off the bat. My Excel is super slow. Okay, so margins are getting a little bit better. That's nothing to write home about, though. Still losing 50 cents on every gap dollar. And then free cash flow. Hopefully Koifin, oh wait, I got distracted. I wanted to find the fully diluted share count. So that is really off. Yeah, our best guess is probably just use the one that was guided to, because the 10Q is, I don't want to take too much time just finding everything. So it's interesting it drops off that much after the second quarter. But what I would do is use the full year, so 154, and then this is very back of the envelope, but I would look at the total anti-dilutive shares. It's about 40 million. So I would do, and since it's all unvested, like that's probably going to get into circulation at some point. So if I was being conservative, what I would do is take that 154 from the guide number and then just add back all the anti-dilutive shares. So, but what I actually do, this is very, like I said, not official, but if I figure I'm not going to fit, like, it would, if you really wanted to get into it, you can find the expiration or the strike price and how likely you think that the options would expire. What I typically just do is take the anti-dilutive and divide it by 2. And I find that that generally gets you closer with very little time. So 174, which is actually fairly close to the guide on the second quarter. So that's what I would use as share count. So let's see here. So it's already, okay, 30. So market cap, wow, it's actually lower than I would have expected. Interesting. So we got a $5 billion market cap. Yeah, that's pretty consistent with. Yeah, Koifin is basically where I'm at, 174. Great. Let's see if they have free cash flow. This is basically what I do all day. Just filming it. Okay. 300 million. What does the latest balance sheet say? Okay, so we got 600 million. Yeah, Koifin looks like it's pretty up to date. They got debt. They actually have a decent amount of debt. So it's about 300 million instead of 400 million net cash. So we got about a $5 billion enterprise value. And just real, okay, I keep getting distracted. Let's put in free cash flow here. Okay. Once again, my fiscal years are off for this company, but I can change that. Okay, so negative 35 million. And I like to double check. Koifin is usually pretty good. Sorry, it probably hurts your eyes, me scrolling so much. Yeah, it's pretty similar. Negative 37 versus Koifin will not take out capitalized software. So sometimes you have to look at that. Okay. I mean, this looks kind of off to me. The fact that these are the same. So they probably actually didn't. Yeah. I mean, very rarely in the S1s are they going to actually give you the quarterly free cash flow. So what Koifin did, it looks like, is just estimate it. So we don't actually have Q1 2023. So that's all we have. I guess we can look at annual, and sometimes it gives us a picture. So negative 17. My database is getting too big. It bogs down Excel. But yeah, since Koifin doesn't have the quarterly numbers, then sometimes you just can go to the annual and figure it out and then fill in what is left out. Okay, I know this is not correct. 8 plus 8 minus 20 is not 23. So, come on. Oh, we're done. I didn't even have a formula set up there for some reason. My fault. Okay. And then negative 17. So it looks like it was negative 12 here. So it's kind of strange that free cash flow dipped that much, even though. Yeah, so we can check out the cash flow statement. Why did it deferred revenue is down quite a bit? So that would be one question to look at. I mean, that's pretty much the gap right there. And then, yeah, they have a little bit of capitalized software. Like I said, that's what Koifin misses. I try to include that in free cash flow if I can. Okay, so over the past 12 months, they have still free cash flow negative, so I don't love that. I typically don't invest in free cash flow negative companies. But let's see, okay. Trailing 12 months. Let's do that for every. let me know for future. The Excel, it just might be too slow to do these videos with the screen recording feature and everything. Just maybe my laptop is too slow. Okay. So free cash flow, negative 40 million over the last 12 months. Huge gap losses. I mean, that's pretty much all stock-based comp, I'm sure, is the difference there. But the bright spot is that growth is accelerating. So we like that. And like I said, that's because they have a big chunk that's legacy and then another piece that is growing much faster. So this looks promising. I will definitely keep an eye on this one. This has turned into a rubric video. I mean, this might be a longer one just because, like I said, all the better companies take a while to really dig into. And I haven't done a lot of prep work on this one, so we could probably skip my last two that I wanted to get to, which are Zoom and Paycom, companies that have just got absolutely crushed. They don't really have that much growth anymore, so it might just be easy pass. But I mean, Zoom is trading for like 7 times EV to free cash flow. So if I were them, I'd just be doing a crazy buyback. Okay, just cleaning up some formatting. Hope this video is not too boring for people. Okay, so that is step 1. Step 2 would be to gather all of the subscription revenue and cloud revenue, cloud ARR, see what the growth rates are trending like. And then you can sort of then look at, okay, if I value the for the fast growing piece. So in here, we see that where's cloud ARR? Cloud, not Clower. They don't even have cloud ARR? What is that? That was the big metric in the S1. Now they're just giving us subscription ARR. I don't love that. Maybe they have a presentation or something? That's sort of weird that they wouldn't give us that. Let's see what they got here. It's a really high net promoter score. I just saw that. Okay, so we have subscription. We might as well jot that down if that's what they're using. That's their big metric that they clearly want everyone to look at. Okay, there we go. Cloud ARR 606. I feel like Cloud ARR, I mean, that's really strong. That's weird that they're not focusing on that. Okay, then we'll find subscription revenue. 172.2. I feel like their metrics are weird. That is not what I would necessarily be bragging about, is subscription ARR. I mean, maybe it's just a more clean story. But wow, I really apologize for my slow Excel. So the subscription revenue seems like it's accelerating really nicely. We got from 19 to 39, 61 to 59. So pretty solid. And then our cloud ARR from 214 to 201, 164, 119 to 104. So it's definitely decelerating significantly, but it's not that many companies out there growing 100% anymore at this scale, definitely. So I feel like the market is probably valuing it just off the cloud business because it was like, what, less than 10 times trailing sales? Okay. So on a quarter over quarter basis for cloud ARR, we have 27 to 21 to 15 to 15. So it's growing more like 75%, but even if it's growing 50%, we got 600 million, so call it 900 million in forward ARR and a $5 billion enterprise value. So call it 5-6 times forward for 75. It's actually not that bad. That's why I'm spending so much time on this. I'm actually kind of interested. So on the subscription side, we have 600 million trailing 12 months subscription revenue growing almost 60%. So yeah, once again, it's probably like 5-6 times forward, but it's just not as clean of a story as people like, right? Wall Street loves a clean story, but if you got a legacy business and all that, let's see here. Just kind of adding it to the system. So, wow, I was totally behind the ball here. I did not realize it actually IPO'd a while ago. I remember reading the S1 when it first came out, but then I just haven't really followed it. Okay, now we can actually go to the system, see where it's at. I don't really know anything about management. Don't really know anything about the competitive landscape, but we can just very roughly run it through the system. Okay, so this is old news because the share count was actually lower than expected. We got some accelerating revenue, so green lights. Margins are just not good, so that'll hurt it. I have no idea. Let's use, I mean, if we wanted to get crazy, we could give it a 30 times multiple. This is just super back of the envelope. Doesn't really matter right now. Yeah, that's probably high, giving it 30%, let's say. But the thing is, the cloud business is growing really nicely. That could definitely grow at 30%, but the overall won't. So right, the legacy will come down and then the cloud will accelerate it. Oh, shoot, I pressed the wrong macro. Oh, I can press escape to cancel. Never actually escaped a macro. Okay, we're almost at 25 minutes here, and I've only gone through rubric, so I might have to make another video. This could be like just a rubric. The macro did not escape. This could just be like a rubric S1 teardown. And I really haven't even gotten into S1 or any of the qualitative factors. Took us a while to just get our data right. I would definitely go through if I had more time. I mean, this is amazing net promoter score. I would go through the whole subscription ARR. Would see exactly what this is looking like. I mean, we could do it. Not a huge rush. Okay. It's definitely accelerating. Do we have any retention rates or anything that we can find? Well, I remember dollar-based net retention 20%. They don't usually give that cues. We can check on. Let's see here. Maybe you. There we go. 4 way better than S1. Has all the final numbers. S1, there's variations of it. There's so many like drafts, but this is way better. Okay, no gross retention. Let's see what they have for us. It's probably actually really hard for them to show gross retention because it's a cloudier story. No pun intended. Yeah, I mean, retention rates are definitely dropping off, but like I said, that's some opportunity because it's a messier story, but we have, okay, accelerating revenue, definitely. Mission critical, I mean, I'm sure it's somewhat mission critical. Recurring revenue. So, yeah, because the maintenance and license business is becoming smaller, I feel like the cloud is probably over 50%. I don't think they had any goodwill really. I would just be interested in the history of the company. Yeah, I would say it's probably not that hard to replicate. There's just a lot of competition in the space. There might be some pricing power though. It might bold that, I just don't know for a fact. But this is just the first draft. I'll go way deeper. This is usually just to see if it's interesting enough to dive really deep. See, the margins will hurt it. But really good growth. Feel like they don't have any customer diversification problems. I can't imagine it's the leader, but I don't know the space super well. I don't even really know what they do. I don't even know if they have a CEO or who they are. Obviously, they have a CEO. Okay, leadership. Hopefully, we get a founder in here. Nice. Co founder, the CTO, and co founder CEO. That's great. Okay, so what do they even do? Some cybersecurity business. Well, on a mission to secure the world's data. Like, I just don't know how this is different from a Zscaler. I mean, it must not be. So it's like their data protection. It's not necessarily network. Where's competitors? Might help me get a sense. Competition. Super micro. Oh, wow. We rely on a limited number of contract manufacturers, including Supermicro. That's the one that has just blown up from NVIDIA. Load our software onto Supermicro servers to deliver Rubrik branded commodity servers. Okay, so that's hardware. Interesting. Whoa, this is different than I. Oh, okay. So it really like, wow, it more competes with Commvault. This is more like a storage cyber like protection company. Interesting. Oh, wow. Served on the board of Nutanix. Oh, the CFO is a Atlassian. That's great. Co-founder was rocket fuel. It's kind of a random background. Yeah, I don't quite understand this company yet. Okay, so we've run it through the system, and it actually scores really nicely. I'm not going to lie. And then the price is lower than we expected. So this shows up as a top 100 company. So it's definitely interesting to do a deeper dive. Let's see here. The guide. Yeah, the only thing that's really bringing it down is the margins. I think the valuation is very reasonable. And then growth is pretty solid. I feel like the free cash flow will come. Yeah, this is interesting. Thank you, Jim. I would have to read the transcript, read through all this, look at the subscription revenue, but this is definitely going in the watch list. So I guess this is a small S1 teardown. I don't want to go super longer than this. Okay, here's the transcript. Rubricians, Rubricons. I don't know, it's kind of seems like a weird history of this company. So they announced a partnership with CrowdStrike. That's good. Also a strong partnership with Zscaler. Those are the top two companies. So they're definitely doing something right. It just seems like a lot of, I'm blanking on the word, buzzwords. Seems like a lot of buzzwords. It's like, how many times is zero trust in here? Actually, only 8. Converged. Um, okay, so they have a $21 million outlay for payroll taxes. So free cash flow actually wasn't that terrible. We completed our IPO in April. So when did they finish Q1? So we might actually not be including that. So it ended April 30th. So yeah, the cash, wow, they had quite a bit of debt. Once again, like, how does that happen? I guess they they better have a lot of insider ownership. Um, so the guide for the year is 31% actually. We expect free cash flow of negative 95. Okay. So 824 and then negative 95. So it's not going to get better. It's going to get worse this year. Yeah, so maybe the valuation isn't that cheap, honestly, for negative 100 million in free cash flow. Yeah, I mean, looks like they're trying to really accelerate the cloud business, but that's even decelerating. So this is really easy comps, and they're getting 31%. So I'm actually a little high on this guide. But they've got to be conservative for the first couple quarters, especially out of the gate. So what's our year over year for Q2? 30%. So what we really should be doing is finding out the legacy business versus the new business and seeing what this implies. But quarter over quarter, yeah, it's just a harder story, right? We got Q2 27 in 2022 to 12 to our guide is 5. Yeah, the free cash flow guidance I just really don't love. That's why this valuation is down here. But the subscription revenue is interesting. And then we got the cloud ARR. That's nice. Let's see here. Let's just put in the subscription ARR. We don't really need this CapEx section. Once again, for the 4th time, my fiscal years are off here. So I'm going to do fiscal year 2025 as 2024, and then I'll change it later. Okay, so we got 856 Q1, and then 784, 725, 655, 587, 533, 460, 382, 316, 272, 215, 184, 153. Okay, so this is our subscription ARR. I wonder, it's probably just smoother than subscription revenue because there's some accounting stuff where they recognize a greater percentage of the contract. It was like the classic Alteryx thing back in the day. It's probably some of that. Okay, so subscription ARR. Let's see here. So that's a pretty big decel from 86 to 46 year over year. So went from 100%. Really, the Q4 is like the annual. So 96 to 47. That's a pretty big drop off. What about on quarter over quarter? So it seems like it's stabilizing quarter over quarter, but still 12, 11, 8. Okay, 9. Yeah, that's where we get a little. It does seem like it's stabilizing a bit. So this is more like a 40% grower, I would say, not a 100% grower. But that's because this is why it's complicated, because the sub ARR definitely has legacy business in it. So if you were really doing pure. So this is what's interesting, right? We can take the sub ARR, subtract out the cloud ARR. And so the cloud business is definitely the majority. So that's why we're seeing overall acceleration. So yeah, if we just focused on the cloud business, it'd be growing 100%, but sort of stabilizing, right? 15%. So it's really growing more like 75%. And we had 600 million ARR out of like a total of around 800 million. And margins should improve going into next year. Yeah, overall, it's pretty interesting. Definitely want to keep an eye on for sure. So I'm going to keep it in my system and the watch list. And then, I mean, it doesn't seem like just a no-brainer buy here, but 70% growth is best, right? Like Sentinel-1 is growing 40% at the same size. And it's probably trading for more. Like, so let's say this grows at 30%. What's our forward EV to sales? Less than 6, probably. Yeah, 5.7. Sentinel-1 is 6.7. And right, the rubric ARR was on a quarterly basis. If you look at the 15% quarter over quarter, you can annualize that to 70%. And it was just a little bit less than this run rate. And Sentinel-1 is trading for a higher valuation. Interesting. Just from that, I would be like, and a lot of people think Sentinel-1 is undervalued, so we'll see. I don't know. Free cash flow margins, that's the thing Sentinel-1 is really improving on. Yeah, they're now positive. So maybe it's deserved. The market, when you really look into all these things, it's like a lot of times it's fairly efficient. It's really amazing. But in the times of fear, it can be wildly inefficient. Yeah, I don't know. I'm definitely going to keep an eye on it. But that cloud ARR, not a lot of businesses that are growing that fast. Okay, so since we took the guide down, let's see. I think if we brought this up to 30, I mean, it's possible. Bring this up to 30%. I don't feel that comfortable giving it any higher margins because it can't even produce free cash flow yet. And then multiple, that seems reasonable. I wouldn't go higher on that. So 86, yeah, I mean, that brings it into top 6% of all companies. Anytime you find a company that's almost breaking into the top 5%, that's interesting to me. So thank you, Jim. This video really just turned into a rubric breakdown, but I will just keep monitoring it. It doesn't seem like an absolute no-brainer, just because I don't know enough yet, but I definitely will keep an eye on it. And then I'll have to get I don't know if we can do these videos because I just get stuck on something. But that's all for today. I'm already at 40 plus minutes, but thanks for watching.